The law calls this an eviction. The mortgage company calls it foreclosure completion. Arthur calls it impossible. He stands on the sidewalk in work clothes, holding a briefcase, watching a locksmith drill through the door of the house he has paid for every month for 6 years. He checks the time. 8:12 a.m. He has to be at work in 48 minutes. This is not a dramatic morning. No shouting, no violence, just paperwork reaching its final conclusion. Arthur believes this will resolve itself because, in his mind, accuracy ends arguments. In the American housing system, it doesn't. Arthur Miller manages logistics for a medical supplier. Hospitals cannot run out of things. If surgical gloves leave Cincinnati late, Arthur knows. If syringes stall in Phoenix, Arthur knows. Hospitals depend on certainty. Arthur manufactures certainty in spreadsheets. He tracks shipments by the minute, corrects mistakes before they become emergencies. Arthur believes systems work, not because they're perfect, but because precision is enforced. Mistakes happen when people stop paying attention. So, in 2019, he bought a house. Not a large one, a stable one.
Sarah wanted a garden. Maya wanted the school district. Arthur wanted the number. A fixed-rate mortgage, 30 years, predictable payment. $1,650 a month. He automated it that night. Every Friday, they reviewed finances, car repairs, school expenses, groceries, but never the mortgage. The mortgage was solved. And for 3 years, it was a solved problem. Stops being monitored. But in finance, unsupervised systems continue moving. By 2022, the house felt permanent. Shoes by the door, homework on the table, life inside it. And life is loud. Arthur's company merged. He worked nights to protect his department. Sarah handled school meetings, doctor visits, everything else. Their attention moved outward, which is how financial disasters begin. Not with recklessness, with distraction. A letter arrived from the county assessor. It looked like junk mail. The neighborhood was worth more now, so taxes were higher. Another letter arrived. Insurance had changed its risk model. The premium doubled. The bank paid both automatically from escrow. Arthur never saw the bills. He only saw the payment amount, $1,650. What he didn't see was the account underneath going negative. The bank sent a notice, escrow shortage. It arrived the same week his mother broke her hip. He put it on the handle later pile. Later never arrived. Arthur did not ignore the warnings. He categorized them. Because he had seen them before. Servicer changes, insurance reversals, false default notices. Every system produced noise, and every time the noise resolved. So these letters became familiar, not danger, paperwork. Humans react to novelty. This was not novel. The visible payment stayed $1,650. Underneath, it changed. Taxes rose, insurance doubled, escrow went negative. New true payment, $1,940. The system recalculated. Without urgency, without explanation. Mortgage systems do not panic.
They update fields. So the next month, Arthur paid the correct amount, the old correct amount, $1,650. The bank accepted it, but did not apply it. It entered a suspense account, a place for incomplete payments. From there, nothing counts. Arthur believed the mortgage was paid. He confirmed it and slept peacefully, because to him it was finished, but the bank marked him 30 days late. Neither side knew the other existed. The loan became delinquent. Most people imagine foreclosure begins with a missed payment. For Arthur, nothing had been missed. If the money left your account, when would you stop believing it was paid? 30 days. No urgent call. Mortgage servicing is tiered. First stage, automation. Letters generated, dialers called, voicemails left. Arthur saw unknown numbers. Spam had trained him to ignore them. The letters looked identical to harmless ones before. Same envelope, same typography. Nothing distinguished crisis from routine. So the system escalated quietly. 30, 60, 90 days. No decision occurred, only timeline advancement. Then came the HOA fine. $50. Wrong shade of paint on the garage door. Arthur rejected it on principle. He had resolved smaller HOA disputes before. They always negotiated. But this time, the HOA attorney filed a lien. $50 became $1,800. Which would worry you more? A large bill you expect, or a small one you don't respect? The lien notified the mortgage lender, and the bank saw another creditor attached to the property. Another creditor means risk to collateral. The file moved departments, from customer service to legal. This was the moment the outcome became irreversible. The foreclosure process became mathematical, not emotional, not discretionary, just procedural inevitability. Arthur still believed this was a billing issue. The system now classified it as a defaulted mortgage loan. One morning, his login stopped working. Account restricted. He called the bank. 45 minutes of hold music. Then a representative said, "Your loan has been accelerated." Acceleration means the full mortgage balance is due immediately. Arthur explained the payments, the confirmations, the history. The representative explained the status: 120 days delinquent. To reinstate $14,200 by Friday. Arthur laughed, briefly, then stopped, because the voice did not change tone. He asked them to apply the payments sitting in suspense. They could not. The file had left customer service. It had moved to foreclosure. Servicing agents no longer had authority. From that moment, the problem stopped being explainable. It became provable. If you had proof you paid, but your mortgage still showed unpaid, would you think the mistake was yours or theirs? Arthur did not give up. He entered the administrative maze. He faxed documents proving payments. They requested newer statements. He sent those. They requested notarized copies. Each request took days. Each response reset the review clock. He wired $2,000 to reduce the reinstatement quote. It was rejected. Partial payments not accepted in foreclosure status. The loan servicing transferred to a new company mid-process. All prior documentation had to be resubmitted. His lawyer filed a motion. The court date landed after the auction date. The system was not refusing him. It was simply operating on parallel timelines. Arthur was working in days. Foreclosure works in deadlines. Hope lasted 3 weeks. The foreclosure auction occurred on a Tuesday morning. Arthur was at work. He believed legal review paused everything. A trustee read a case number. An investor bought the house. The mortgage converted to a real estate-owned asset. Arthur learned from a Zillow notification. No one called him, because legally, no rule required they do. Ownership had already moved. The eviction hearing was brief. Arthur brought payment records. The judge examined the deed, not history, not fairness, not effort, just title. Foreclosure transfers ownership. The hearing determines possession. Arthur lost possession. A notice appeared on the door. 3 days to leave. On the morning of the eviction, the locksmith finishes drilling. The deputies were polite. They always are. 10 minutes to pack essentials. Neighbors watching. His daughter crying. She asks why they're leaving. Arthur cannot explain suspense accounting to a child. He carries bags to the curb. The locks change before he reaches the sidewalk. The house looks identical because foreclosure does not destroy homes, it transfers them. We believe systems protect careful people, but systems protect completed conditions. Arthur didn't lose the house because he stopped paying his mortgage. He lost it because the bank no longer treated his payment as valid. The housing system did not malfunction. It functioned exactly as designed. A mortgage feels like a promise you make to a bank, but it's really a schedule you make with time. Arthur kept his promise. He just missed the schedule. And most foreclosures don't begin with a crisis. They begin with a normal month. So the question isn't whether you would stop paying. It's this. If this were your mortgage, where would you think the mistake was?